Now that Beijing has responded to the closure of the Chinese consulate in Houston by shutting down the American consulate in Chengdu, taking back the premises over the weekend, investors have been forced to contend with the possibility of a re-escalation of tensions between the two superpowers. This is especially with November's election on the horizon. China bashing is one of Trump's favourite distraction tactics, something that's going to be more and more necessary for him in the coming months, given his disastrous domestic policies. It's one of many narratives the market will be keeping an eye on this week beyond the regular COVID-19 analysis. Another thing for US investors to deal with is Wednesday's Federal Reserve rate vote and press conference. The central bank isn't expected to unveil any new stimulus on the 29th, though the phrasing of its statement may give an indication of when they are preparing to act next. In terms of data, the most important figures arrive on Thursday as the market gets their first taste of America's second quarter GDP performance. Following a 5% contraction in the first quarter at the annualized rate, analysts are forecasting a whopping 35% collapse in the second quarter. How much? Obviously, that's such a colossal decline that any movement around that figure could be key in determining how the markets actually react on Thursday. Elsewhere, the durable goods order readings are released on Monday, with CB consumer confidence on Tuesday, pending home sales on Wednesday, jobless claims on Thursday, and the core PCE price index and Chicago PMI on Friday. If that wasn't enough, the week's earnings calendar is also unbelievably stacked. Boeing is up on Monday, with McDonald's, eBay, and Starbucks and Visa on Tuesday, and General Motors, General Electric, and Facebook on Wednesday. Then on Thursday, the world's biggest companies collide as Apple, Alphabet, and Amazon all reveal their latest results. For Apple's third quarter performance, analysts are looking for an 8.7% drop in earnings to $1.99 per share, with a 5% decline in revenue to $51.13 billion. This is the company's been hit, with production issues in places like China due to the impact of the coronavirus pandemic. As for Google parent Alphabet, it might be another battle between rising engagement with people stuck at home on their phones and on their computers and falling ad revenue as companies sort of pull spending because of the coronavirus pandemic. Estimates point to a huge 40.7% decline in earnings to $8.43 per share, alongside a milder 3.3% dip in revenue to $30.66 billion. Finally, Amazon, arguably, if you had to pick one company that's benefited the most from the pandemic, it would be Amazon. It's expected to see a 27.5% surge in revenue to a massive $80.84 billion in a single quarter. However, earnings per share are expected to be down pretty significantly, I think falling 74% to $1.34 per share. That's due to COVID-19 related costs from dealing with increased demand to keeping employees safe, which isn't exactly something Jeff Bezos is known for, but something Amazon is supposedly still spending money on regardless. It's a sign of how investors are sort of feeling at the moment heading into this week, but gold just hit a record high. Though it's been on the up and up all year, save for a sharp downturn in the first couple of weeks of March, the precious metal was really accelerated in the last week. From last Monday to this, it has surged 6.5%, lifting it above $1,930 per ounce for the first time in its history. If that's a sign of how the week's going to go, then the likes of the Dow Jones might have something to worry about. Though it might end up becoming dependent on the strength of those mega earnings from Apple, Alphabet, and Amazon to try and swing sentiment into the positive.